China is grappling with a financial crisis of staggering proportions. The nation's total debt has ballooned to an estimated $50 trillion. This colossal sum is more than 3 times the country's entire annual economic output, its GDP. To put this into perspective, this debt pile is larger than the combined GDPs of the United States and the European Union. The immediate effects of this debt mountain are already being felt across China. The once booming economy is showing clear signs of contraction. Instead of prices rising, the country is experiencing a deflationary spiral. Data from February, March, and April of this year, 2025, have consistently shown this worrying trend. Deflation can discourage spending and investment, further slowing down the economy. Beyond the stark economic indicators, there is growing social unrest. Reports from May 2025 indicate that mass protests have been breaking out in several regions. Citizens are worried about their jobs, their savings, and their future. The government's ability to manage this discontent is being severely tested. Given China's significant role in the global economy, its financial woes have far-reaching implications. International markets are watching nervously. A key factor contributing to China's enormous debt burden is the unique financial structure of its local governments. For decades, these regional authorities became increasingly dependent on land sales. By the early 2020s, income from these land sales accounted for as much as 40% of their total budgets. This reliance created a precarious situation, tying local finances directly to the fortunes of the property market. Initially, this model appeared to be a resounding success. As China's economy boomed, property developers eagerly bought land, fueling construction and urban expansion. Local governments used the proceeds to fund infrastructure projects, public services, and economic development initiatives. However, this dependence on a single volatile revenue stream was inherently risky. The problem intensified as local governments started to borrow against anticipated future land sales. This practice directly contributed to the accumulation of massive local government debt. Officially, this debt stands at over $12 trillion. However, many experts believe the true figure is much higher, possibly between $18 trillion and $20 trillion. This discrepancy is due to hidden debts incurred through off-balance sheet entities known as local government financing vehicles, or LGFVs. When the property market eventually began to cool, local government revenues plummeted. The land-dependent model, once a driver of growth, has become a significant source of China's current economic woes. The roots of China's current debt crisis can be traced back to its response to the 2008 global financial crisis. Beijing launched a massive economic stimulus package to insulate China from the global downturn. A key component of this stimulus involved encouraging local governments to borrow heavily and invest in infrastructure projects. To facilitate this borrowing spree, local government financing vehicles, or LGFVs, became widespread. These state-owned enterprises could borrow money from banks and bond markets, channeling funds into infrastructure and development projects. By the mid-2010s, local government debt, much of it held through these LGFVs, had already reached approximately $6 trillion. The stimulus had successfully propped up growth in the short term, but also sowed the seeds of a much larger debt problem. This pattern of borrowing created a culture of debt-driven growth at the local level. The LGFVs became instrumental in financing everything from new roads and bridges to sprawling new urban districts. This historical context is crucial for understanding how local government debt escalated so rapidly. In an attempt to address the overheating property market, Beijing introduced the 3 red lines policy between 2019 and 2020. Its primary goal was to deleverage the property sector by imposing strict financial constraints on developers. These red lines set limits on developers' debt-to-asset ratios, net gearing ratios, and cash-to-short-term debt ratios. Companies that breached these lines faced restrictions on their ability to access new financing. The intention was to instill financial discipline and reduce systemic risk. However, the policy had immediate and severe unintended consequences. Many property developers, already highly leveraged, found themselves suddenly cut off from crucial funding sources. This triggered a liquidity crisis across the sector. Instead of a gradual cooling, the policy precipitated a sharp downturn, pushing many developers towards financial distress. The impact was swift and brutal. Property developers, unable to secure new financing, struggled to complete projects, pay suppliers, and meet their debt obligations. The three red lines policy, while designed to mitigate long-term risks, inadvertently acted as a catalyst for the very crisis it sought to prevent. The stringent three red lines policy sent shockwaves through China's vast property sector, leading to the collapse of some of its largest players. The most prominent casualty was China Evergrande Group. Once the country's second-largest developer by sales, Evergrande found itself unable to manage its colossal debts. In early 2021, the company officially defaulted on its obligations and subsequently filed for bankruptcy protection. This event sent tremors not only through China's financial markets but globally. Evergrande was not an isolated case. Country Garden, another major property developer, faced a similar predicament. While it narrowly avoided a formal default in late 2023, it too was struggling under a mountain of debt. The struggles of these giants painted a grim picture of the entire sector. The collapse and near collapse of these property titans had significant ripple effects. One of the most immediate was the dramatic decline in land sales. With developers facing a credit crunch, their appetite for acquiring new land plummeted. This sharp reduction in land sales directly exacerbated the financial woes of local governments. Beyond the macroeconomic figures, China's escalating debt crisis is inflicting a severe human cost. Millions of ordinary citizens are finding their lives and livelihoods upended. Among the most affected are public sector employees. There are reports that up to 90 million government workers are struggling to get paid on time. Salaries are being delayed for months, and performance bonuses have been canceled. Some are forced to max out credit cards or take out high-interest online loans just to cover daily expenses. The crisis has also shattered the financial security of many savers and investors. The Shenzhen Treasury bond scandal saw a government-affiliated bond provider default, wiping out the life savings of hundreds of elderly investors. Similarly, the collapse of Zhongji Enterprise Group in late 2023 left around 150,000 high-net-worth investors with worthless investments. These financial losses and employment uncertainties are fueling social unrest. In Henan province, rural banks froze withdrawals in 2022, affecting approximately 400,000 depositors. When depositors protested, they faced crackdowns, detention, and harassment. More recently, in May 2025, mass protests have reportedly erupted in several regions. Worker protests over unpaid wages are surging in sectors like construction, education, and healthcare. While China's financial woes are a domestic issue, their implications are undeniably global. The sheer size of the Chinese economy means that any significant downturn will send shockwaves across the world. One immediate area of concern is global supply chains. If Chinese factories cut back production, it could lead to disruptions for businesses worldwide. Countries that export commodities to China are also vulnerable. Nations like Australia and Brazil could see a significant reduction in demand. The ambitious Belt and Road Initiative is also likely to be affected. Partner nations may face unfinished projects as Chinese funding dries up. China's current economic model, built on an ever-increasing mountain of debt, is proving to be unsustainable. The $50 trillion question is how this situation will resolve. Experts are increasingly concerned, with some predicting that without dramatic action, nearly one-third of China's provinces could face serious budget shortfalls. Beijing is not without options, and China possesses certain advantages. Most of its debt is owed internally, rather than to foreign creditors. The country also holds over $3 trillion in foreign exchange reserves. However, the sheer scale and interconnectedness of the debt present an overwhelming challenge. The government has already taken some measures. It has issued special bonds to help local governments refinance their existing debts. Efforts are also underway to revive the struggling property market. Ultimately, the crisis poses a significant challenge to the legitimacy of the Chinese Communist Party. Navigating this period of economic turbulence will require more than just financial maneuvering. It will necessitate transparency, difficult reforms, and a potential re-evaluation of the growth model that powered China for decades.